You are entering an investing state of mind the system doesn't want you in. The truth. You want answers? Michael Covel has them on the Trend Following Radio Network. And now, reaching over 130 countries and territories, Michael Covel.
You know, when I think back to my start of trying to get inside the mind of really good traders, in the early 90s, there was only really one place to start. And I remember picking up the book Market Wizards and reading it and thinking, I understand about half of this. Like it was deceptively dense. And I'm sure a lot of people can still go back and read Market Wizards and New Market Wizards and still not understand all the details because it's right there in front of you, but sometimes it's hard to get your arms around. So with that, and I don't think I'm the only person, I think that those books really affected an entire generation. I mean, those are still today. If you haven't read them and you want to try and make money in the markets, what's wrong with you? That's my question. So I'm lucky today to talk to the gentleman that wrote those books, Jack Schwager. And Jack has a new book out that I think anybody that liked the Market Wizards and like the New Market Wizards and like Stock Market Wizards, this one's called Hedge Fund Market Wizards. You're going to like it. I read it over the weekend. It raises all kinds of questions. It gets you thinking in the right way. And anyways, Jack, thank you for being here on the show today.
Hey, Mike. Thanks for the introduction. Appreciate it.
Well, before we even get into some of the content and some of the specifics here, I think a lot of people would like to know, like, what makes Jack get up every morning? What makes you tick? Like, what's your daily grind?
Not terribly exciting. I kind of have a routine, no set routine to speak of. It depends what I'm doing at the time. So last couple of years, it was basically changed. I deliberately left my last day job and wanted to take some time to write a couple of books. The first one of which was Hedge Fund Market Wizards, and the other one which I've just completed. So my grind is just varied from day to day. I'd write whenever I felt it was working, which was most of the time, I guess. And I take time breaks whenever I wanted to, whether it's take a walk or to do something else, but nothing terribly exciting.
Well, but you've built the life that you've wanted.
Yeah, what I basically have done for quite a number of, even my day job was a day job run from a home office and sort of working in conjunction with a London-based company. And even now, my other endeavor will be to be managing a portfolio, again, working as a consultant, not as a daytime job. So I've kind of managed to be working full time and be retired at the same time. So it works pretty well.
I think that's the dream everybody wants. That sounds that's the way to approach it. Well, let me get into your new work, because I think this is what people really want to know about. And for any of you folks out there that have looked at Jack's first three books, especially the first and second one, this book has got, this isn't a book of just semi good names in the trading space. It's like the guys. I mean, these are the people today in 2012 that are kicking royal tail on the markets are in Jack's new book. So as a fellow author who is in this space, I have to, there's a certain side of jealousy, of course, that these great interviews. But the thing that caught my eye, because I actually saw this, interview on 60 Minutes. And so when I saw it in your book, Jack, I thought it was great. I just want to kind of repeat this quote for a second. And it's a quote from a 60 Minutes episode with a rock climber named Alex Honnold. And Lara Logan asks him a question. He says, "Do you feel the adrenaline at all?" This guy would climb these sheer 1,000-foot cliffs, no ropes, no nothing. I mean, it's insane. If you haven't seen this on 60 Minutes, go see it. And Alex goes ahead and he says, "There is no adrenaline rush. If I get a rush, it means that something has gone horribly wrong. The whole thing should be pretty slow and controlled." Now, there's got to be a story as to why you opened your book with that. I love it. That's great. I mean, I want to steal it, but now I can't because you've already used it.
Well, I actually love that you picked that up. I spend a lot of time sometimes picking the right quotes for things, and usually people, and I had books I've written where I've had a quote for every chapter, and I spent a lot of time kind of getting the right quote. Nobody ever pays attention to it, and so forth. And well, the reason I picked this one, and the reason I liked it so much, and of course I had no intention, I never even thought that when I was watching 60 Minutes and watching this story on this amazing solo climber, that it would lead to a quote that was relevant to the book. But when he said that, I said, that is really the epitome of trading. And it also flies in the face of what people think trading is all about. You mentioned trading to most people, and they say they have this picture of this adrenaline-filled room and people shouting orders, and it's all this tumult and emotion and aggressiveness and panic and all these things that people picture trading is about. And the irony of it is that the people who are really good at it, you walk into their rooms and it's like a library, and it's all carefully planned out. It's all controlled. There is no emotion. And that is really what a good trader is. I get one example, a trader I interviewed, and you mentioned I have some high profile names. I also try to pick out people who no one knows. And one trader I interviewed for this book is a prop trader who, ironically, the only reason I knew about him is my son got a job as a trading assistant, and he was working for him, and he told me about him. And the amazing thing how he managed constantly, he was always winning, even when he was wrong in the market. And I had this interview with him, and the day I came in, I remember this. So it was one of these days where it was after a period where the market had gone up for several months, almost every day. This was back, I guess it was early 2011. And the day I came in, that day, the market finally had a big break. And I knew that, for my son, I knew that he had been short, and I came in that day, and he was completely it was like a day where you would expect him to be really ebullient and enthusiastic, and really, bubbling over, sort of making back a lot of money. And you couldn't tell anything had happened that day. And I'm sure if I had walked in and it was the reverse and he'd lost a lot of money, it would have been the same thing. Just kind of even keel. And that's the thing about really good traders and really good rock climbers, and I'm sure really good a lot of things. It's not an emotional thing. It is really a careful, controlled thing. And if there's a lot of motion to it, then something is wrong. And that's why I love that quote.
Do you think you think that aspect can be learned?
Well, if it's not learned, then you're going to lose money. So the market will teach it to you. You have to find a way, I think you have to find a way to trade where you minimize the emotion. And there are lots of ways to do it. And, a simple way is, and I've given this advice through the people I've interviewed and quoting them on it, and also it's on my own belief, is one pretty good idea is, and Bruce Kovner of Caxton was the first one I think I interviewed in one of my books who said this, was before you put on a trade, decide where you want to get out. Decide where the trade is wrong before you get in. You do it then, you have complete objectivity, and you take away the emotion and all the turmoil of trying to decide what to do for position once you're in if it's not going right. So by doing that, if you say put on a position, you say, okay, I'm buying X at 75, and if I'm right, it shouldn't go to 73, and I'll put a stop in at 73, and that's the end of it. And you don't have to worry about it anymore. If you're wrong, you'll be wrong, and you know what you lost, and it's something you decided that's in line with what you can afford to lose, and it's in line with what the trade shouldn't do, and you remove the emotion. If, however, you just buy at 75 and it starts going down, and then it's at 74, and then it's at 73.50, now you're deciding, what should I do? And it gets to 73. Well, maybe it'll bounce back, and you have to make all these decisions. Well, a simple way to get the emotion out is make the decision where to get out before you get in.
And what's really interesting about that statement is that especially in this book, that applies over so many diverse trading styles. This is not this book is, when everyone gets this, you're going to see there's so many diverse trading styles in here. But one of the commonalities is clearly, and I even quote the one gentleman here from the first chapter, Colin O'Shea, and he says he wants to have a price point to invalidate his hypothesis before entry. And he's not a trend trader per se. He's more of an econ guy. But I think you're making that point. And I see that commonality across this book, regardless of style.
Yeah, the styles are, in fact, extraordinarily different. In fact, they're almost more different than if you tried to make up different styles, you'd have trouble making up styles as different as the range of styles and the people I interviewed. So there's really no commonality, none, in what these people do to make money. But there is certain, as you point out, there is certain commonalities in terms of things like, how they manage risk. Not all the same, but this idea of deciding what invalidates your trade is one that is shared by a number of traders. And Colin O'Shea states it as well as anybody. And he makes this one point that I particularly like, and he makes it in a way that I like the way he phrases it. He says that most people pick their stops by how much pain they can stand, and that's entirely wrong. What you need to do is pick your stops by where it invalidates your trade, not by how much pain you can stand. And if where it invalidates your trade is too painful, then that means you should be trading smaller. Not that you should pick a closer stop and have one that you can live with. If it's too much money to the meaningful point, then trade smaller. And if it's less than one contract, well, that's just not a contract. That's just not a trade you can do.
Yeah, I really enjoyed the chapter that Colin had, and he had some interesting discussions in there. And we've got a bunch of different places I want to target, but he had an interesting view how he was talking about the Nasdaq bubble period time, and it wasn't that he was necessarily trying to go short at 5,000, but rather 4,000. He was looking for that confirmation of things had changed, which I thought was really a nice direct way of saying it.
Yeah, well, the important point is, and he has some interesting, there are a lot of things in this book that are, I kind of think, different than people think. They're from traders who've been very successful, but what they're telling you is really not the way most people think it should be done. So mention bubbles to people, and what they think is, oh, wait, the way smart people make money in bubbles is to anticipate the bubble top and go short into the bubble and make money from all the fools. And interestingly, column on the subject of bubbles saying really the best way to make money in bubbles, well, there's two parts of it. The first part is you actually want to be long during a bubble because bubble moves tend to be relatively smooth. After the bubble bursts, it gets to be very, very jagged and very tough to stay with the trade on the downside. So actually the easiest place to make the money is along with the fools, so to speak. But of course, you're going to do it in a way that's tail protected. So that's the first thing that's sort of non-conventional about the way he looks at bubbles. And the other part of it is okay, you're expecting this thing, you look at this thing as a bubble. When it breaks, you're ready to now trade from the short side. And even though you're trading from a much worse price than you might have gotten in only a few weeks earlier, but it's the only way to do it, because if you try to do it while the market is in its vertical ascent, odds are that, or not the odds, but you have a very strong possibility of having to absorb an enormous amount of loss, probably more than you can stand, because when you get into that type of psychological phase, there's no telling how high the market goes. The Nasdaq happened to top a little above 5,000, but it could have been somewhere above 4,000, it could have been above 3,000, or it could have been above 7,000. When you get into those markets, there's no rationality. A stock goes from 1 to 100, a stock goes from $10 to $200 and then back to 10 or even down to 1. If it went to 200, it could have gone to 300. So there's just no way of telling. So those are some of the points. And the other point that relates to this whole bubble idea is when you do get the bubble finally burst, and this is kind of a tangential related idea that he brings up that's important, the best way to take advantage is not necessarily the direct way. So the direct way would be, okay, short Nasdaq. Well, the problem with that is the Nasdaq move is going to be awfully choppy. In fact, during the summer of 2000, and most people don't realize this or have forgotten this, you would think that if you went short the Nasdaq sort of in April or May 2000, you'd be sitting pretty and it would have been an easy move and you would have made lots of money. Well, the fact is that somewhere along the line, not that much further, somewhere in summer of 2000, there was a 40% plus rally in the Nasdaq. 40% plus. That's a hell of a retracement. And I don't know too many people who can stand that type of heat. So odds are, if you were short, you would have gotten knocked out. Now, what did O'Shea do? He actually didn't go short the Nasdaq. He said to himself, well, okay, this was a bubble. It's over. What does that mean? Well, it means the economy is probably going to weaken. What else does it mean? Well, it means that interest rates obviously have got to come down from where they are now. So what did he do? He went long bonds. And the beauty of that is that the bonds were a relatively smooth up move, totally correlated. The up and move in bonds were totally correlated with the down move in equities, but he found a much smoother way to do the trade. So that leads to one of the other lessons I cite in the book, is that how you implement a trade is actually more important than the trade idea itself.
I'm going to jump around some because I don't want anybody to accuse me of saying, well, Covel, you picked the first chapter. You only read one chapter. That's not the case at all. So, but I have to tell you, I got the e-file, so everyone knows, I've got the e-file out there, and I actually got the hard copy yesterday. And, look, I know everybody's in love with ebooks and all that kind of stuff. But let me tell you, I'm holding this thing in my hand right now. It is, I don't know, 1.5 inches thick, 1.25 inches thick. It's sharp looking. This is, I don't know. For me, I want this on my shelf. I mean, I want this thing that has some weight that I can hit somebody over the head with. And this is a dense book. And I'm going to jump around a little bit on chapters here, because I think there's all kinds of interesting characters in this book, and I'm not going to even mention them all by name today. But I want to jump ahead to speaking about Ed Thorpe. And I remember back in the day, it was probably inspired by something originally said in one of your books about blackjack. And I went out and I bought the Beat the Dealer book, and I read that thing. And I was attempting back in the day to try and connect all that thought process. And here you are, you have this great interview with him where he's talking about all of his gambling experiences and his trading experiences. And as you point out, you're like, most people would probably not see the connection. Maybe you can speak to some of your looks a very interesting conversation with Thorpe. Yeah, well, a couple of things. Well, first, let me answer directly your point here about connection between gambling or we should maybe say not gambling, but games of chance and trading. And in Thorpe's case, he did both. So there's a natural connection. But the best way to illustrate it may be to give a specific example. So take a game like blackjack. Blackjack, if you just bet a fixed amount every hand, you're going to basically lose money over time because the house has an edge. The edge in blackjack is less than it is in most games, and if you're gonna play a game in a casino, you might, the best odds is blackjack. But it still is a losing edge. However, what Thorpe realized mathematically was that if you varied the bet size dependent on how attractive the individual hand looked, that you could take a game that had a negative edge and turn it into a positive edge. And that's a really powerful thought. I mean, here is something, it's like you have a coin that you're flipping, and the coin doesn't even land on, it's not even 50-50 heads. It lands on tails 52% of the time. Yet he realized that because it's not purely random, that by betting more when the odds are better, you could take that 52% odds and turn it 52%, 53% in your favor, just by varying the bet size. And the analogy to trading is that one thing, and again, you need to, a lot of this is having some level of sophistication in what you're doing. So most traders maybe will
bet the same thing all the time. The really good traders, when they have a trade they really have strong confidence in, or they think has great return to risk potential, they will bet more. As George Soros said, as I quoted Druckenmiller in one of my books, quoting Soros, is you have to know when to step on the accelerator. So part of it is betting more. And in blackjack, it's when there are different ways of doing it, but when there, say, when there are not many not many tens and picture cards out, you bet more, and vice versa. In a simplistic way, that's what that concept is. So you're taking a game which has negative edge and turning it positive edge by varying the bet size, and the same in trading. And in trading, it also means that when the odds are less, you either bet less, you take a smaller size, or you don't trade at all. I'll take a jump here over to another trader in the book who's actually more of an investor. He's the only person in the book that is more akin to a long-only investor, because he just goes short occasionally always less than 10%. So he's much more like a long-only investor. And this is Kevin Daly, and over a 12-year period where the S&P was like flat, he was up over 800%. And part of it, of course, is a stock picking, but a big part of it was just by being out of the market at the right times. And so when the odds were not good, he didn't trade. He traded very small. He had very small positions. So this idea of varying the position size is a really important idea that can improve anybody's trading. So that's one example of a connection. I can talk a lot. I kind of skipped Thorpe in this broader sense because I was trying to address your question. But if you want, I can go into something.
Well, here's the thing I want people to understand about this book. This is not a book. I mean, I read it over the weekend, but I could probably read it about 5 more times right now. This is not one of these books that you are going to just sit down and gingerly mosey your way through. You're going to have to sit down, read this, go back and look through it. It is dense and it covers a lot of material, cradle to grave, A to Z. And there's so many interesting little side notes and nuggets. And I thought one of the most interesting things about Ed Thorpe was that he found perhaps Bernard Madoff before anybody else.
Yeah, that was one of in fact, in Thorpe, there was like it was just like an astounding list of things that he was first at. I mean, in fact, of all the people I've interviewed, he is probably the single most amazing person in so many different ways. So, okay, so you're right. So let's pick Madoff. He actually found Madoff probably, I'm trying to think how many years before.
His description of that was great, though. The way that he kind of figured it out was just it's worth the price of admission just to read that.
And he did it very carefully. He did it through analyzing the trades. And I mean, he realized, and it's in the book, and I won't go into detail in this podcast, but he put together that there was no other conclusion other than this had to be a fraud.
Yeah.
And he discovered that before many years before Marco Polo actually did. Nobody knows about it because he didn't make a big push about it. The investor who asked him about it, he basically told that, I would get out. This is a fraud.
It's one of those side stories that I could have you talking for a half hour, but just it's one of those things worth reading. Like I said, I'm going to jump around, but I want to. There was
before you jump, just one other thing which I thought was amazing about what he was first at is that he found the Black-Scholes model formula.
It's true.
About 4 years before Black-Scholes, published their results. So he was really the first person to figure out the formula for pricing options. But in those 4 years, he was making tons of money trading it, and he just didn't want to publicize it to the world.
Well, you could probably say that maybe some of these traders that didn't get the publicity in the academic sense, perhaps maybe their achievements should have got them the Nobel Prize. Perhaps, maybe some of the academics got all the notoriety, but some of these great traders were actually implementing some of these great principles before the notoriety hit.
Yeah, that's something that I think very, very few people, I mean, I certainly wasn't aware of it. I doubt hardly anybody is aware of it, that he was really the first person to actually use the formula, and he did it many years before it was ever published. So that was another kind of amazing. And he also invented first person to do statistical arbitrage, first person to do convertible arbitrage. He was just an amazing person. Another thing, just from the academic side, this is another tidbit I kind of mentioned because I found it sort of so incredible. He was in a PhD for physics and got to his thesis writing stage and decided he didn't know enough math. So he went back and started taking graduate courses in math and then got a PhD in math. And he never went back to finish his thesis in physics, but besides that, he had done all the PhD work as well. But this is the kind of individual he was.
You know, everyone's listening here. Like I said, this is a very dense book. There's a lot of information here. But one of the comments that caught my eye in the book, considering you've really interviewed a phenomenal number of top traders, and there's a gentleman in here named Steve Clark, stat arb trader, I believe. And I think you make the comment in here where you said he's the most honest trader that you've spoken with. Was it just for this book or in general overall?
I think in all my books. And that was an amazing interview. I'll give you the context of this. And this is not in the book, so here's something that's not in the book at all that we can talk about. There was a trader that worked for Steve Clark. It's a group, Omni in London, and there's several hedge funds, and there's the general hedge fund that he oversees, and a couple of other strategies, separate ones. And there was a global macro guy who was very good, and I went to interview him. Now, that interview ended up not being in the book. The guy has a very good record, and he's a very good trader, but the interview just didn't work well. And without going into much detail, but in all my books, I have to do more interviews than I actually use because I have to feel that the interview, once transformed into a written chapter, is going to work as a written chapter. And in this case, I didn't feel I could transform it. But he was the catalyst for my going there to begin with. And then I knew there was this other fund that the main fund also looked good, but it was an arbitrage fund. And it's very difficult to make arbitrage funds sound interesting. So I was even reluctant to ask for an interview. But I figured, hey, I'm going there anyway. I might as well interview Clark, who runs the arbitrage fund and who's the head of the whole group. So I had the first interview first, and then I did Clark's interview, and I had such low expectations. I thought it was going to be boring. It was going to be very difficult to turn it into a thing. And he goes into his life story, a kid from sort of the lower middle class in a suburb of London and, no college education, and how he got into trading and ended up, becoming in arbitrage and all these other things. But his life story was really interesting, and he was very, very honest about all aspects of it, and very emotional at times, and very honest about what he liked and what he didn't like, and how he felt unfulfilled in his life. And it was just sort of almost a brutal gut level of honesty in that interview. And that's why I say, of all the people I interviewed, I thought he was the most genuine and honest of all. And he came up with a lot of extremely colorful anecdotes. And so personally, I really liked the interview a lot. I even considered making the first chapter. It was one of the ones I was considering as a possible first chapter. Yeah,
that line caught my eye because, like I said, you've talked to so many different guys, and that seemed like such an affirmative statement. I was like, wow, that must have really struck you, this interview, this gentleman.
Yeah, you could see the emotion when we were talking, and it's sort of like you watch an interview show sometimes, and the person gets a bit choked up or whatever, and they'll focus in on the face, and you could see the emotion. Well, I don't know if it comes if I got it across in the book, but it was that type of emotion that came across in the interview.
I told you, this is what happens when you write a book with all these interesting people and different anecdotes and stuff. And so this is how my mind is circling around your material. But so there's another trader that you spoke about in here, and listen to the audience out there. We are lightly touching because these are dense. Like I said, lightly touching on aspects of these chapters. You have a gentleman named Jaffrey Woodruff. I'm pronouncing that right, I think. Yes. Okay.
Yep.
And he's a CTA out of Charlottesville. And I thought the interesting thing about him, not a trend following trader, not a counter trend trader, but a pattern trader with a firm called QIM, self-taught programmer. I think the most interesting thing for me from that was definitely not a silver spoon guy, if I'm reading that correctly, but he was definitely influenced by Bill James, the sabermetrics guy. I mean, we're talking Moneyball here, seemed to be his philosophical foundation for a lot of what he does and how he ended up developing his trading firm. Am I beating up the right trade?
You got it exactly right. Yeah. If there is an idol that he would have in terms of expressing his philosophy, Bill James would certainly be it. And it's interesting how these things, which are unrelated to trading, actually have analogies directly to trading. You might not otherwise expect it. And in the case of Bill James and the whole topic of sabermetrics, it's the idea that by looking at different types of statistics and patterns, you could get a lot more information than you could by what was the typical popular RBIs or whatever. There were more interesting statistics that you could get, or that would give you patterns that were more meaningful. And it's very much along the lines of Moneyball, and well expressed by that. In case of Jaffrey, he essentially took that philosophy and tried to, and ended up finding patterns in the markets and building an approach that could find patterns. The big trick there was to do so without overly data mining and curve fitting. And some of the stuff, of course, gets to be proprietary, and there was some of the stuff he would only go to in detail just so far. But the essence of it is, and that's why I call the chapter The Third Way. As you said very correctly, he's neither a trend follower nor a counter-trend trader, but his process is really to find patterns in the market, and that is what he does.
Well, let me ask you, because I've got a couple more guys and some big picture principles I want to run over. But let me ask you, as the guy that goes down this path, and there was a certain amount of time between this book and your last Market Wizards books, what were some of the things that you would want to be asked about that I mean, obviously it's in the book. There's a tremendous amount of material in the book and your own views too. But what's your big takeaway? How did this change you? How did this book change you? How did all these interviews change you?
That's a good question. I can give you, well, let's see what I can think. I can think of one comes to the top of my head. I'm sure there's more than one way.
Putting you on the spot, Jack. Putting you on the spot.
No, that's fine. That's great. Keep me from falling asleep. That's good.
Oh, come on. I wouldn't let you fall asleep.
No, I'm teasing. You're actually asking very good questions. So it's an interesting interview for me too. And that's good. I'm enjoying it. So, that is an excellent question. So how did it affect me directly? I'll give you a good example. Jimmy Baladimas, the trader I talked about before, that my son apprenticed to. And, well, his style of trading, and we may as well go into it here, and he is probably talking about, first, of all the books I've ever written, he is the most different trader of anyone I've ever interviewed. And as I begin that chapter with a line that I think is very apropos, and it's also one of the better opening lines I have for any chapter I've ever written. It's a very short one, and it's simply Jimmy Baladimas breaks all the rules. And he does. And he sells into rallies. He doesn't use stops. He does things that are really reckless or seemingly reckless, but yet he makes money year in, year out. And I actually not facetiously, even semi-facetiously, but also seriously, in the conclusion of that chapter, warn people that this chapter should be looked at like those late night infomercials where, don't try this stuff at home. So having said that, though, one of the things he does, and one of the ways he makes money, even when he's wrong, is he's constantly trading around positions. So he has, these months, when I went to interview him, the 3-4 months before I interviewed him, the market was up every month. He was short every month, and he made money every month. Or he broke even, but he didn't lose much. And the reason why that was true is because he's always trading around the position. So if he's short, the market goes down, he takes some. It goes down more, he takes some more. It goes back up, he resells it. So he's constantly making money trading around his positions. And I kind of believe in the idea of trading around positions anyway, but I think seeing the power of that, the way he's applied it, and understanding that even when you're wrong, if you do that part of it well, you could still end up ahead, was, I think, an important influence. And I think it influenced me to do more of that in my own trading, to be more inclined to take some off when it's going my way and put it back on. And one interesting thing about doing that is, if you think about it, it's going to help you. When is it going to help you? Well, it'll help you when the market goes into a correction. Well, you'll pick up some money that you wouldn't have. It may also help keep you in the trade, because if you're picking up money on the correction, you actually are happy when it's going against you, because then you can put the position back on. So instead of getting out of the whole thing, you're actually putting it back on. So it's very beneficial in those type of cases. Where is it going to hurt you? Well, it's going to hurt you if you take some off and it keeps on going. Well, what does that mean? That means that you've made money on the rest of it, so you make less of a windfall profit. And I like that trade-off. I like the idea that you're doing something in trading where it's going to help you when you would have been losing, and you're just going to give up some money when you would have been making more. I kind of like that trade-off. So I found that kind of an influence. It wasn't something that I had never done or anything like that. It wasn't a sudden insight. The insight was more understanding the power of it and getting a better appreciation for that as an approach. It is also, if you think about it, a way where you could be sort of not wrong necessarily on a trade, but let's say you go long or short and market ends up chopping around, doesn't go anywhere. If you're doing this, you could actually end up making money on a trade where the market doesn't go anywhere from beginning to end, because you're selling some when it's going your way and then putting it back on when it comes back. So that's a good example of how there was an influence, but it's not certainly the only way. A lot of these traders had definitely have had an influence in things they said ringing true, and maybe reinforcing just things, even if I already knew them.
Jack, overall, the gentleman in this book, is it a fair assessment to say, self-starter, entrepreneur types, really not silver spoon guys? I mean, a lot of these are self-made men.
I think so. If you think about all these people, and I'd have to go one by one, but almost all of them that I think of really came from, they didn't come from wealth. A few of them did come from upper class backgrounds, to be sure, but most of them really didn't, and some of them came from really, almost poor backgrounds. Thorpe grew up in the Depression, as an example. Clark, a poor working class family, that type of thing. So those are probably more representative of the backgrounds of these people. Very few really had any money when they started.
Well, let me. I know I mentioned early on that there are some very large names in here, and so just to whet the appetite of folks that are listening to this. So your second chapter is about a guy who, as far as I can tell, is the man when it comes to making gross money. I think you say he's made $50 billion for investors over 20 years, and we're talking about Ray Dalio at Bridgewater. So let me ask you, without going into and sitting here like I've done before on some of these other traders, what can you tell us about Dalio, your lessons, your insights, what you took away, some feeling that perhaps isn't really in the book, something that we're talking about the gentleman who has really just made an amount of wealth. It's hard to count. So what can you tell us that's not out there floating in the ether already about this gentleman?
Well, there's just a couple of things. For one thing, let me just say, in terms of his accomplishments, you have records out there like Joe DiMaggio's that maybe never get broken. And if I had to say, of all the traders I interviewed, what record will never get broken, Thorpe may be on his number of winning months, percentage of winning months, but Dalio has done one thing that I think is almost inconceivable that anybody could do again, and that is having a huge percentage year, and I forget what it was, like 30% or whatever. It was some very large winning, managing $50 billion. You would have asked me, a few years ago before he ever did that, I would have thought it would be hard pressed to even make money managing that much money. It seems like such a huge disadvantage. But to be able to make a huge return managing a giant sum like $50 billion, that is like one of the most incredible feats that have ever been achieved. And
nearly systematic to add, right?
He's systematic here, but systematic different from
Absolutely.
what other people think of systematic.
Absolutely. Save that for the read. They'll have to read about that.
Well, yeah. Well, we can tell them, we can say here, that systematic without technicals, really.
Yeah.
So.
It's very interesting.
Dalio is very opinionated. He knows what he thinks is right and where he wants to go. And, I think like a lot of great people, have that quality, like Steve Jobs in a different field. Sort of the visionary people have that self-assurance and understanding. One of the important things there's a number of things that we won't go into all of them, but one thing I think that's important that Dalio brings out is that markets behave differently in different environments. So if you look at markets, and I'm speaking now fundamentally, not technically, but if you look at certain fundamental factors and try to find consistent ways in which they behave, according to Dalio, you're dead before you start, because that's not the way markets behave. Markets will behave very differently, say, if you're in a recession than if you're in a liquidating depression type of economy. Same fundamentals will work very differently, and you have to understand that. Otherwise, you're just going to be completely wrong, because you're trying to force one model across different markets, and the markets are just more complicated than that.
We've only got so much more time left here. I know I can't keep you all day, but hopefully we'll make the best podcast, so when people want to hear about this book, this is where they're going to go. So let me get you to be teacher for a second on a principle that is featured around one particular trader, and I'll let you name him, but I think it applies to a lot of these traders, and it's a kind of a very academic sounding statement, and perhaps you can break it down, but asymmetric positive skew trades. That's going to take some people a little bit of time to sit down and kind of wrap their arms around, but it's an extremely important point.
Yeah, it is, and I love that philosophy of trading, and it probably, I'm sure, comes through in the book. So what does that mean? Well, to put it in plain English, it means that you put on trades that have the potential to make a lot of money, but even if you're totally wrong, they can't lose very much. Now, the simplest example of this is a long option trade. Now, a lot of people will say, well, buying options is a mug's game. Options are overpriced, and you'll bleed money, and they'll do studies where if you buy always buying options, you'll end up losing. And all of that is true. And I'm using options only an example of how to set up a trade where you can make a lot more than you can lose. And I'm trying to also, in doing that, I also need to explain what's wrong with the way most people think about buying options. What most people really miss is that while on average, options have a somewhat of a negative edge, just like if you buy insurance on your home, the odds are, your house is not going to burn down, and the percentage, even across the whole population, home insurance buyers will lose money, relative to the amount of money they collect in premium. And if that weren't true, insurance companies will go out of business. So that part of it is true. It has a negative edge. Okay. It's inevitable. Long options have to have a negative edge because you have to entice people to take the risks to sell you the option. Having said that, what the people miss is you don't have to be in the game all the time. The beauty of options is you can pick your spots. And if you can pick a spot where the market has a much better chance for having a large up move or a large down move at that spot, then options provide you actually a positive edge, but more importantly, they give you a way to trade that type of situation, and have a very large potential on the upside while only risking a little bit on the downside, namely the amount you pay on the option. So when some of the traders I've interviewed make a big deal about structuring their trades in ways where the upside is open-ended and the downside is very limited. Jamie May is one who's always does it, I think, on every single trade. Kyle Moshe does it for most of his trades. And the simplest way is, as I said, is long options, but there's also being long CDS. There's other ways of doing those types of trades. But the simplest way and the way applicable to most people, or the way most people can do it, is by being a buyer of options, but at the right point in time. The great thing about it is that it's a way of controlling risk, but still giving you significant upside potential. And it's one of the ways where these great traders, it's one of the ways in which they are able to get very good return to risk performance.
Yeah, I think it's terribly important. I think the first gentleman you interviewed him in one of your original books, was Larry Hite, was always big on this concept. He had brought this up multiple times with me. So I saw that. I was like, oh, that's right on target. Like I said, as we kind of wrap up, I can't keep you all day. I know people like to listen to you all day. I know I can always learn. But in the rear of this book, it's really cool. And I can't go into all of them. There's 40 of them, and you call them your 40 market wizard lessons. And I think it's obviously you're taking all these great insights and kind of reducing them to something that helps to kind of summarize what's going on in this new book. I want to give you the ability though here to expand on something, because I find this sometimes in my work. I'll get readers and they'll see something and they'll think they found some discrepancy in that I've written about. And I know I'm looking at number one, and number one is you're saying there's no holy grail in trading. I think let's hope most people can believe that's true. But number 26 is interesting, and I wanted to talk about this, the power of diversification. And you mentioned that Dalio says that is his holy grail to investing. So I don't know if you might want to kind of speak to, there's layers of how you're using that term.
Yeah, diversity. There are a lot of things that people kind of gloss over because, diversification, I know it's important. But what I think people don't understand sometimes is how powerful some of these things can be. And one thing about diversification, and I use it in one of my other books, is it's the line, I think, something along the line of, it's the only free lunch on Wall Street. The thing about diversification, if you do it properly, it's a way of dramatically improving return to risk, without really any negative to it, without any downside. And what Dalio's point is, if you have a strategy, and you pick your best strategy, and it has a certain return to risks, and that's good. But if you can find unrelated strategies, truly uncorrelated strategies, that you can increase your return to risk by as much as a factor, if they're really uncorrelated, by as much as a factor of 5 to 1. So he sees there's a tremendous amount of potential improvement you can get in your return to risk, and it's all return to risk, not return, by diversifying. The way he does it is he finds ideas that have different drivers. So he's not paying attention so much to correlation, because correlations are misleading. They're backward looking, and you can have things that were uncorrelated can become correlated, or vice versa. What he prefers to do is to look at things that have different drivers, and if they have different things making the price move, then one should not be related to the other. And he puts together at least a minimum of 15. They have many, many more positions, but at the core, say 15 plus core positions that are completely unrelated. And that is one way he's able to get significant return while still keeping his risk in control. And diversification is something that applies not only to as a trader, but it's also when you're investing. And sometimes that people talk about putting together a portfolio, say, of managers, and people will say, well, yeah, you put too many managers on, then you're diversifying your way you return. And I think that's kind of a very narrow-minded way of looking at it, because if you only pick managers that you feel are equivalent, approximately equivalent in their potential. I mean, you can always pick the managers that are the best in the past, but going forward, you really don't know. So even if someone did better in the past, you don't necessarily think he's going to do better in the future. So, or you shouldn't, because there's a very poor correlation there. So if you're picking managers you think have equal probabilities of getting about the same return to risk, then you should have more. You should diversify, because if they all have similar expectations, you're not reducing your expected return, but you are reducing your expected risk. So again, it has a lot of applications.
You know, one of the things I did not set up here in the beginning is your process for how you selected managers. And you went about saying, okay, I want to target guys superior return risk performance. And I'm going to let you expand on that and how you went about that process. As you think about it, though, one of the questions I would have for you would be your definition of risk as you lay that out.
Right. Oh boy, that's a good sub. Let's take that, and we'll come back to the process. The subject of risk, because this is one, and I mentioned that I have another book that I just finished writing, and in there I kind of have a whole chapter on this. But it's the whole confusion about what risk really is. Now, somewhere along the line, most of the investment community and a good part of the academic community, maybe most of the academic community for that part, has decided that risk is volatility. And the interesting thing, now sometimes it is, but the interesting thing about that is that you can have things that have very low volatility that are extremely risky. And in fact, their low volatility is one of the telltale signs of potential risk. It's not a sign of low risk. It could actually be a sign of potential large risk. And you can have things that look or are very volatile and yet have very low risk. And I guess we can kind of give an example of each. So, and this is where people go wrong all the time. They look at track records and they look I want a guy who doesn't lose much ever and has, makes a little bit of money, and that's great. And that's great as far as it goes, but you have to understand where are the profits coming from. So a lot of hedge fund strategies make their money by putting on the types of trades that win most of the time, but every now and then the train goes off the tracks and you'll get clobbered. But if within their track record, that particular strategy has not had one of those episodes, it looks great. Now, the simplest example I can give you is a strategy like selling out of the money options, okay? So if I were, in fact, if you wanted to be a charlatan in this business and kind of attract a lot of money, probably one of the best ways to do it would be you start a fund where all you do is sell out of the money options, way out of the money options. Now what's going to happen is in just about every month you'll be making money because the markets rarely go to those out of the money, the strikes. So the markets go up or down a little bit, or even moderately is making money. The only time you get hurt is if the market really has a sudden huge move. But the thing is, when it has a large move, you're not only losing money in that type of position, but you're losing money asymptotically because those options you sold that moved 10 cents for every dollar the stock moved or the market moved now start moving 20 and then 30 and 40 and ultimately $1. So your position size is increasing at the same time you're losing money in that type of position. And what happens with these types of strategies is they get these strings of returns, which are very smooth. So low volatility. So the academics will look at it and say, oh, low risk. A lot of investors look at it and say low risk. But in reality, the process is one that has landmines planted sparsely. And it's fine as long as you don't step on one of those landmines. But ultimately, if you go far enough, you will eventually step on a landmine. And that's what happens. So that's an example of, and in 2008, of course, landmines were going off all over the place. And it was largely the worst hit strategies were the ones which had these low volatility, but high risk, what I would call low volatility / high risk strategies. So that's an example of low risk, of low volatility, not only not being low risk, but low volatility actually being associated with high risk. The reverse side of it is a trader like Jamie May, who structures all of his trades, as we talked about before, to be rightward skewed. And what he's always looking for is ways to put on trades where if he's right, he'll make a lot of money on the upside, and if he's wrong, he'll lose a little bit of premium. And there's a number of examples in the book about the types of trades he does. So we're not even going into that type of detail here, but it's basically the idea is that's how he structures the trades. And what does that do? That means that when he's right sometimes, he makes these huge profits. And when he's wrong, he won't lose that much. So you get a track record that has a lot of volatility. But the thing is, if you look at the track record, all the volatility, not some of it, all of it is coming from upside. And so you have a situation where you have high volatility, but his process is still relatively low risk because he can never lose very much on any individual trade the way he structures a trade. So it's a very, very important point, this breaking apart these concepts of volatility and risk. They're very different, and people go wrong all the time by linking them together.
Do you want to, I know we got a few more minutes here left, but do you want to touch on how you look at risk specifically, in terms of your measures? Sure.
I have one favorite measure, which I put in a book. I call it the gain to pain ratio. And it's actually, I kind of always assumed that it was kind of out there and people, but then I started searching for it. I Googled it and I found it was used generically, but I found that actually, even though it's a simple measure and in my mind, just about as good a measure of performance as you could get. If I only had one measure, this is what I would use. But oddly enough, it wasn't actually out there as a standard type of measure. The only place I found it in was in measurements of trading performance, where it's measuring trades, and there's something called the profit factor, and that is a statistic that's out there. And for your listeners who are familiar with profit factor, which is basically looking at the sum of all all your profitable gains to the sum of all your losing trades, that is the same analogous type of concept, but it's applied to a trade by trade basis. However, taking it and applying it to time data, like monthly returns or daily returns, actually it wasn't out there, and it's well, I call it a gain to pain ratio. So what is the gain to pain ratio? It's simply this. You take, let's say if we're using monthly data, you take all the returns and just sum them. And then you take all the losing returns, only the losing returns, and you sum those and take the absolute value of it, the positive sign. And you take the ratio of all your trades to all your losing trades. And that's what I call a gain to pain ratio. And it's actually the one measure I use most heavily, and I can almost do without everything else. If I just give me the gain to pain ratio and monthly data and daily data, and I really can't extract very much more out of the pure data. So the reason why that's so good, and it's why it's better than, I think it's much better than the standard measures. It's much better than Sharpe ratio, let's say, because it will only penalize losses. It doesn't penalize people like Jamie May who have large gains.
It doesn't penalize upside volatility.
That's right. It doesn't penalize upside volatility. It's much better than ratios like the Kalmar or ratio or ratios which basically take your returns to your worst drawdown, which is something I'm not a statistician, but I have a little background in statistics. It's just something that's distasteful from a statistical standpoint, because it's you taking one event, the drawdown, and giving it all the weight, which is just not a good thing to do. The thing about the gain to pain ratio is it counts all the losses. So your maximum drawdown is going to be in there, but so are all the other drawdowns, and so are all the individual losing months. So it's basically weighting every loss you have ever taken. It's essentially taking all your gains and normalizing them by all the losses you suffered to get those gains. And I find that statistic is just extremely meaningful, and it's even more meaningful if you take it down to the daily level. So, and I do have it in the book as an appendix because it is not a standard measure out there.
Listen, Jack, we've taken up your time. It's been great. I think people are going to really enjoy this. Maybe I've already asked this in a roundabout way, but is there any one that just stands out in your head, memorable sentence, feeling, meeting, interaction in this entire process for this particular book that stands out for you? Is there one thing that you just walk away with and say, wow, obviously there's more than one thing, clearly we've talked about that, but is there that one that just kind of jumps out at you?
Yeah, we've talked about, I don't know if there's one, it's hard. It's always, that type of question is a little bit like the question I often
Which child do you like?
No, well, yeah, that too. But let's keep it in the realm of market wizards. One question I get a lot of times is, who was your favorite trader, or who's the best trader? Yeah. And I really have a rough time with that type of question, because there's so many different episodes, that it's and so many different people. It's kind of hard, to think of which one do you take? I
find the commonalities are what I remember. It starts to become that common type of can do, make it happen person. I'm not going to quit. I'm going to survive. I'm going to make it. I'm going to get to the top. I find that's how I end up remembering the people in this world often.
Yeah, and that is a characteristic of a lot of these traders. As is typical in most of my books, you will find a fair smattering of the traders I interviewed who didn't start off successfully, but yet they had that drive. Yeah.
Well, listen, you where were you calling today? Where are you at today?
I am in New York City, overlooking Central Park.
Ah, delightful. Well, I'm in San Diego today, looking downtown San Diego. So, well, listen, Jack, I will get this up hopefully this evening, and I'm sure everyone will enjoy it. I appreciate your time today.
And Mike, so you did a really good job. I really enjoyed this. You asked a lot of intelligent questions, which is the great thing about being interviewed by a trader instead of sometimes someone who knows nothing about trading. But
Well, I appreciate that. Let me ask you though, what's the best place for people to reach you? Obviously, you can go on Amazon, they can buy all the books, but is there a website where people can follow you along, or where can they find more about you?
I do have a website right now, jackschwager.com, but pretty much right now it's more a venue for the books, and a couple of things are posted there. I haven't yet gone to the point of taking it over and really making it something, although at some point I will. For example, now we did this interview. I'm sure I'll put a link up to this and links to other things of that type. So one place is jackschwager.com. Okay. Perhaps not so much what's there now, but we may be there over time in this process. And I did start Twitter for the first time. The book was kind of the catalyst. I started that a few weeks ago. And, I guess that's a start.
Yeah, it's and then you'll be stuck for the rest of your life having to make tweets and Facebook posts and it never stops. Well, the train never stops. So
I guess I'll find out.
Well, listen, Jack, once again, appreciate your time. I'm sure everyone will enjoy this, and have a good day up there in New York City today.
Hey, thanks a lot. Appreciate it.
Take care.
Take care.
Bye-bye. I'm up against the machine, the matrix, the system that doesn't want you to profit. That's what I'm up against. My unique trend following message, getting it out there is not easy. I need your support. I need you to help build my team, to get a louder megaphone, to build a bigger infrastructure. Your support is mission critical. Look, there's no grants here, there's no bailouts, there's no government money. It's Michael Covel and his team against the machine, against the investing machine, getting the trend following message out there. There are all kinds of ways you can help support the cause. You can buy a book, you can buy a film, you can train with my firm, you can learn trend following, and we can help you do that. Real simple. Here's where you go for more information and special offers. Go to trendfollowing.com/win, WIN. That's trendfollowing.com/WIN. Real easy. Go there right now. Take advantage of the special offers. Take advantage of the free reports that we're going to send you. This will help support the cause. This will help to get this fight out there. This will help you to profit. Once again, go to trendfollowing.com/WIN.